I want you to just take a second and picture the skyline of a modern city.
Oh, yeah.
Just close your eyes for a moment and think about what you actually see when you look up. I mean, it's not just concrete and steel holding those structures together.
No, not at all.
You're looking at these massive, gleaming glass facades,
Yeah.
right? Stretching dozens of stories into the air.
Yeah.
You're seeing these sleek, transparent railings wrapping around balconies of luxury hotels or, specialized multi-layered windows covering huge hospital complexes.
The sheer volume of it is staggering when you actually stop taking it for granted. I mean,
Yeah.
modern architecture is fundamentally defined by glass.
Exactly.
It is quite literally the skin of the modern city.
And, all of that glass doesn't just magically appear on the side of a 60-story building.
Right.
It doesn't arrive on a construction site perfectly sized, perfectly transparent, and somehow able to withstand, hurricane-force winds.
No, it has to be heavily engineered. It is a highly technical, incredibly demanding manufacturing process.
It really is.
You have millions of people walking past these structures every single day without giving a second thought to the science, keeping that glass from just, shattering onto the sidewalk.
Which is exactly why we're jumping right into this topic for today's deep dive. We've got our hands on a really detailed financial and operational dossier for a company called Agrawal Toughened Glass India Limited.
Usually referred to as ATGIL.
Right, ATGIL. They're a Jaipur-based glass processor. And our mission today is to totally dissect their business model.
Because their story is an absolute masterclass in how a regional manufacturing company attempts to scale up, isn't it?
Oh, absolutely.
Yeah.
It reveals all the hidden complexities of what most people assume is just a really simple product. And maybe most interestingly for you, if you're an investor or a business owner listening to this, it presents a fascinating financial paradox.
A really big one.
We are looking at a company that is wildly profitable on paper, but is actively bleeding operating cash.
Yeah, it is the ultimate real-world case study of the friction between accounting reality and CAF reality.
Yes.
I mean, a balance sheet can look like an absolute masterpiece while the actual bank account is just screaming for help.
Okay, let's unpack this. Because before we even look at a single financial spreadsheet, we really need to establish where a company like ATGIL actually sits in the broader market.
Right, we need to know what they're actually physically doing.
Exactly, because they aren't out in the desert, melting sand into liquid glass.
They absolutely are not, and that is a crucial distinction to make right away. They do not manufacture the primary glass.
Okay.
They sit much further downstream in the global supply chain. The massive multinational conglomerates of the world, the companies with billion-dollar capital budgets, they're the ones operating the giant furnaces.
Right.
They melt silica sand and float it on beds of molten tin to create perfectly flat sheets of what the industry calls annealed float glass.
Annealed float glass, got it.
Yeah, that is your raw, basic material. So ATGIL buys those massive raw sheets and essentially acts as the transformer. They sit right between the primary manufacturer and the facade contractors or builders who actually install the final product.
So if I'm trying to visualize this supply chain,
Yeah.
the primary float glass manufacturers are essentially like massive agricultural farms.
I like that, yeah.
They grow the wheat, they mill the basic raw flour, and they just ship it out in massive bulk quantities,
The scale is quite similar, yes.
which makes ATGIL the artisan bakery in this scenario.
Exactly.
They aren't growing the wheat. They are buying giant pallets of raw flour, taking it into their heavily guarded kitchen, and baking it into highly specialized, incredibly complex pastries.
That's a great way to look at it.
They're taking a raw sheet of glass and cutting it, grinding the edges so it doesn't, slice someone's hand off, washing it with specialized chemicals, tempering it, laminating it.
They're injecting the value, and if you look at their product portfolio, you get a really clear picture of exactly what kind of pastries they are baking. The core volume driver for them. So the product that keeps the factory floor humming is toughened glass.
Okay.
This is glass that goes through a brutal thermal tempering process. They heat the glass up to around 600 degrees Celsius, which makes it soft, and then they blast it with cold air.
Just immediately.
Immediately. So the outer surfaces cool and contract much faster than the center.
Oh, wow.
And that traps the inner layer in a state of continuous tension, which makes the final product up to 5 times stronger than standard glass.
So that's the bread and butter. Glass on your shower door, basic commercial facades, heavy glass tabletops.
Right, the everyday everyday safety glass.
Right.
But where ATGIL is actively shifting their product mix and where the much higher value addition comes in are products like DGU or IGU.
Which stands for double glazed units or insulated glass units, right?
Exactly.
And this is entirely tied to the green building boom we're seeing globally right now. I mean, you can't build a massive corporate headquarters today without focusing heavily on the energy bill.
The demand is astronomical. IGUs are essentially multiple panes of glass separated by a vacuum space, or sometimes a space filled with a noble gas like argon.
Okay.
That gap acts as a thermal break. It prevents the scorching summer heat from transferring inside and keeps the expensive air conditioning from leaking out.
Makes total sense.
Then you also have laminated safety glass, which is a really premium product. They squeeze a tough inner layer of plastic, usually PVB, right between two sheets of glass.
So it's basically a glass sandwich.
Yes, exactly. And if a heavy impact shatters the glass, the fragments stick to that plastic inner layer instead of falling down like a guillotine.
That sounds essential.
It is heavily used for skylights, impact safety, and it happens to be fantastic for sound insulation in really busy city centers.
Okay, looking at the dossier, there's another product listed here that I just have to ask about. It says heat-soaked glass. And the notes claim it's used in high-risk architectural areas to prevent, and I'm quoting this directly here, spontaneous breakage. Wait, hold on. Glass can just spontaneously explode in a high-risk area if it doesn't get this specific treatment.
It can, yes.
I am genuinely alarmed by this. You're telling me I could just be walking down the street and a window on the 40th floor could just decide it's had enough and shatter.
I know. It is a terrifying reality of physics. While it's relatively rare, it is a very well-known phenomenon in the industry.
How does that even happen?
Well, during the initial raw glass manufacturing process, so back at the giant furnace stage, tiny microscopic impurities called nickel sulfide inclusions can sometimes get trapped inside the glass.
Okay.
Over time, as that glass sits installed on the side of a building, expanding in the hot afternoon sun and contracting in the cold night air, those metallic impurities change their phase and physically expand.
Oh, no.
Yeah. If they expand enough inside a piece of toughened glass, the internal tension is compromised, and the entire pane will shatter without any warning whatsoever.
That is an absolute liability nightmare for a high-rise developer. I mean, you can't have glass raining down on pedestrians just because a microscopic piece of metal got warm.
Which is exactly why heat soaking exists as a process. What ATGIL does is take the newly toughened glass, wheel it into a massive, highly calibrated oven, and bake it at high temperatures for several hours.
Oh.
They are deliberately stress testing the glass. The goal is to force any pane containing those microscopic impurities to shatter inside the oven at the factory, rather than 5 years later on the side of a premium hotel facade.
So they are essentially accelerating time just to weed out the defective panes.
Exactly.
But, I mean, running massive ovens for hours just to wait and see if glass explodes, that has to be a massive bottleneck for their factory throughput.
It slows everything down tremendously, which is exactly where their competitive moat starts to emerge.
Oh, I see.
If a competitor just wants to do basic tempering, the entry barriers are manageable. You buy a standard tempering furnace, hire a crew, and start undercutting prices on simple shower doors.
Right, a race to the bottom.
But the barriers to entry absolutely skyrocket when you start talking about high-quality insulated units, complex lamination, and managing the yield on these heat-soaking ovens.
It's because it's so technically demanding.
And getting the certifications required for premium products like ISO 9001 or the Indian BIS standards, that requires serious documented process control.
Right, so it's not just about having the cash to buy the expensive oven. It is about not ruining your own profit margins by breaking way too much glass on your own factory floor. It's all about yield management.
Precisely. And physical scale is another massive filter for competition here. ATGIL processes what the industry calls jumbo glass.
Jumbo glass.
We are talking laminated architectural sheets up to 3,000 by 6,000 millimeters.
Let's just do the math on that for the listener really quick. 3 meters by 6 meters. That is roughly 10 feet by 20 feet.
Yes.
For a single continuous sheet of glass.
Imagine the structural physics involved in simply lifting a piece of fragile, heavy material the size of a large truck trailer.
It's mind-boggling.
Moving it across a factory floor, washing it, and loading it onto a truck without snapping it in half.
Which actually perfectly explains a very specific detail I noticed in the dossier. It mentions that ATGIL has its own fully owned logistics fleet.
Yes, they do.
And at first glance, I thought, Why bother owning trucks? Just hire a freight company, right?
That's what most businesses would do.
But if you are baking a custom 20-foot-tall artisanal pastry that literally shatters if you hit a pothole too fast, you are not handing that off to some gig economy delivery driver.
Absolutely not.
You want your own specialized trucks with your own highly trained drivers who know exactly how to strap down customized architectural glass.
Relying on third-party logistics for jumbo glass is just a recipe for catastrophic damage rates.
Yeah, that makes sense.
Owning the fleet ensures handling reliability, and it also allows them to tightly integrate with the construction schedules of their major clients.
Right, they can deliver exactly when the crane is ready.
Exactly. And their customer reference list really reflects that capability. They are supplying projects for DLF Midtown, Power Grid, Genpact,
Huge names.
major convention centers, hospitals, and luxury hotels all across the region.
You know, it seems like a pretty reliable investment rule of thumb.
Yeah.
If you want to spot a company riding the wave of commercial real estate in infrastructure development, you don't necessarily have to bet on the developers themselves.
Right.
You just look at whoever is supplying the highly specialized mandatory materials to those construction sites. They are essentially the picks and shovels of the modern skyline.
It is a very strong framework for analyzing industrial growth. However, if you are analyzing this dossier with an investor's mindset, you do have to apply a heavy filter to those major client names.
What do you mean?
Well, when a B2B manufacturer lists corporate giants like DLF or Power Grid, it proves a history of rigorous qualification.
Okay.
It means the developer audited ATGIL's factory, checked their defect rates, and officially approved their glass for a specific project. It does not mean they have a guaranteed, recurring, software-as-a-service style revenue stream.
Ah, I see.
Every new high-rise is often a brand new, highly competitive bidding process.
So they still have to fight for the next contract every single time.
Every time.
But looking at the numbers here, they are clearly winning a massive share of those fights. I mean, the growth engine here is running incredibly hot. Let's look at the revenue curve.
Let's do it.
In fiscal year 23, they did 40.60 crore in total income. By fiscal year 26, that number rocketed up to 100.06 crore.
The jump from FY25 to FY26 alone was 71.6% year over year.
That is just wild for a physical product.
Achieving that kind of physical output growth in heavy manufacturing is incredibly difficult to manage.
And it is not just top-line vanity metrics either. Their profit after tax, their bottom-line PET, went from less than a single crore, just 0.97 crore in FY23, to an astonishing 21.60 crore in FY26.
It's massive.
They went from basically breaking even to minting over 20 crore in pure profit. The margins are just fantastic. We're looking at an EBITDA margin of 33.2% and a PAT margin of 21.6% for FY26.
For anyone tracking manufacturing benchmarks, an EBITDA margin over 30% is exceptional territory.
Right.
It strongly validates the value addition strategy we discussed earlier. They aren't selling a commoditized building material.
They're selling a highly engineered product.
Exactly. They are charging a premium for engineered safety and climate efficiency.
To top it off, their balance sheet looks incredibly responsible. Total borrowings are sitting at just 24.67 crore against a net worth of 115.83 crore.
Very healthy.
That leaves them with a microscopic debt-to-equity ratio of 0.21x.
From an accounting perspective, the income statement looks like a flawless execution of a growth strategy.
It really does. But, and here's the big but, this brings us to the twist in the story.
Here we go.
This is the financial paradox we promised to unravel at the very beginning of this deep dive. If you look at the income statement, everything is bright green. But the moment you flip the page over to the cash flow statement, a massive structural crack appears in the glass.
A huge crack.
Despite recording 21.60 crore in net profit, ADGIL suffered a negative operating cash flow of 8.50 crore in FY26.
Just let that sink in for a moment. They reported 21.6 crore in profit to the tax authorities.
Yeah.
But the actual daily operations drained 8.5 crore in cold, hard cash out of the business.
To a layperson, that honestly sounds like a typo in the document.
Yeah.
It is like looking at a highly competitive bodybuilder who appears incredibly muscular and outwardly healthy, right?
Right.
That outward appearance represents the soaring revenue and the 33% profit margins. But when the doctor actually checks their vital signs, their blood pressure is through the roof and their organs are silently failing.
That's exactly what it's like.
If I am looking at a 100 crore revenue line, and I know the margins are super high, how does the bank account go down by 8.5 crore? Are they just like letting clients walk away without paying? Where's the cash physically hiding?
You are touching on the absolute most dangerous pitfall of scaling a physical business. If we connect this to the bigger picture, it is called the working capital trap.
The working capital trap.
You have to separate the concept of profit, which is just an accounting metric tracked on paper, from cash flow, which is the actual oxygen a business breathes.
Okay, I want to break this down for the listener because it's so crucial to understand. It's like opening a wildly popular restaurant.
Okay, go on.
You have a line out the door, so you're technically profitable on paper.
Right.
But you have to buy all your meat, vegetables, and wine on Monday with cash.
Mm-hmm.
You serve the customers on Wednesday. But if all those customers pay with a corporate credit card that doesn't deposit into your bank account until the following month, you can easily go bankrupt while being the most popular restaurant in town.
That is a perfect analogy.
You literally just run out of cash to buy the next week's groceries.
The cash is trapped in the timeline of the operations. For ATGIL, out of their roughly 100 crore in annual revenue, they have more than 100 crore tied up in working capital.
Wow.
Let's look at the three buckets where that cash is actually frozen. First, they have 34.54 crore sitting in receivables.
Meaning they successfully manufactured the glass, they delivered it to the skyscraper on their own trucks, they sent the invoice, and they legally recorded the profit on their income statement.
Yes.
But the construction company hasn't actually wired them the funds yet.
Exactly. Over a third of their annual sales is currently sitting as IOUs from contractors and developers.
Yes, it's stressful.
Second bucket, they have 29.41 crore tied up in inventory. This is the raw float glass stacked in the warehouse, the work in progress moving through the tempering ovens, and the finished jumbo panels just waiting on the loading dock.
So you have to buy all that raw material with actual cash today to build the product you will deliver next month, hoping to collect the cash 3 months from now.
You see the trap now. And finally, the third bucket. 36.60 crore locked up in short-term loans and advances.
Advances to who?
Well, in heavy industry, you often have to pay upfront advances to your massive raw material suppliers just to secure your place in line for the float glass.
Ah, I see.
Or pay upfront for logistics and specialized chemical supplies. So when you combine those three buckets, receivables, inventory, and advances, that is over 100 crore in cash completely frozen in the operational pipeline.
That is staggering.
When your revenue grows by 71% in a single year, the sheer volume of cash required to feed that expanding pipeline grows even faster. Growth aggressively consumes cash.
So even with those staggering 33% profit margins, the machine is so hungry for working capital that it eats all of its own profit and still needs another 8.5 crore just to keep the lights on.
Exactly.
Which immediately makes me question the sustainability of those margins. I mean, if you are a regional player dominating your local territory, you can command high prices. But as they scale up and try to win national contracts, aren't they going to face fierce competition?
Undoubtedly.
If you want to win a massive hospital contract in a totally new state, you usually have to drop your price or, give the developer 120 days to pay instead of 60.
Right. You have to offer better terms.
And both of those moves will crush their cash flow even further.
It is the defining tension of their business model right now. They cannot simply stop growing. They have immense market demand, but they cannot fund that growth from their own internal cash flow.
Which means they have to look outside. They have to raise money.
Yes, they do.
The dossier outlines their master plan to plug this hole, which is a proposed preferential issue. They're looking to issue up to 17.6 lakh equity shares and 46.80 lakh warrants. And these are priced at 109 rupees each. They are trying to raise a total of 70.04 crore.
So for you listening, if you aren't super familiar with a warrant, it is essentially a financial contract. It gives an investor the right to buy a share of the company at a fixed price at a specific date in the future.
Okay.
In this specific deal, the investor pays 25% of the cost upfront and then has to pay the remaining balance when they exercise the warrant within 18 months.
So why do it that way?
It allows the company to secure a pipeline of future capital without diluting the stock all at once.
But raising 70 crore still comes at a really steep cost to the founders, doesn't it? You're slicing the ownership pie into much smaller pieces.
Oh, absolutely.
The dossier notes that the fully diluted share count is going to jump by 36.4%. The promoter holding so, the percentage of the company the actual founders own, will drop from 64.16% down to 58.43%.
That's a significant drop.
They're giving up a very real chunk of their empire just to feed this growth engine. Where exactly is this 70 crore going? Is it all just disappearing into the working capital black hole?
Well, a significant portion is definitely earmarked for working capital, yes, to stabilize that negative cash flow we talked about. But a large chunk is also for capital expenditure.
Building a new factory.
Specifically building out a new facility called Unit 3, which is projected to cost somewhere around 24 to 30 crore.
Okay, this is where I have to push back a little on their strategy. I'm looking at their current capacity utilization right here.
Okay.
Unit 1 is only running at about 57% capacity for toughened glass. They still have massive headroom in their existing factory. Why on earth would they spend 30 crore building Unit 3 when Unit 1 isn't even maxed out yet?
I know, it seems totally counterintuitive, but it actually comes down to a concept called fixed cost absorption.
Fixed cost absorption.
Think about running a factory like renting a massive apartment. Whether you sleep in it for 1 day a month or 30 days a month, the rent is exactly the same.
Right.
In manufacturing, your factory lease, your specialized management team, and your massive logistics fleet are fixed costs. If you build a massive facility and only run it at 40% capacity, the burden of those fixed costs on every single pane of glass is huge.
So your margins suffer.
Exactly. By building Unit 3, they are adding specialized product lines that allow them to aggressively expand their sales network nationally. If they can push total utilization up closer to 80% across the board, the fixed overhead is spread across millions of more units.
Oh, I see. So the per unit cost drops dramatically and the margins actually expand.
Yes.
Okay, so as an investor, you have to weigh this aggressive, high-margin, cash-hungry strategy against the rest of the market. And the dossier gives us a brilliant peer comparison to test this again.
It really does.
Let's look at one of their major competitors, Sijal Glass Limited.
Yeah.
If you compare these two, you see the ultimate structural debate in manufacturing.
It is a stark contrast in corporate strategy, for sure.
Let's pace through the numbers here. Sijal Glass is an absolute giant compared to ATGIL. They have a massive footprint across India and the UAE. Their FY26 revenue was 401.36 crore.
That is roughly 4 times the size of ATGIL.
Right. And crucially, Sijal is not bleeding cash. They generated a highly positive operating cash flow of 51 crore.
So through sheer scale and maturity, Sijal has effectively solved the working capital trap. They have the leverage to demand better terms from both their suppliers and their customers.
But there is a massive trade-off here. Sijal's profit margins are dramatically lower.
Very low.
Their EBITDA margin is only 16.5%, which is exactly half of ATGIL's staggering 33.2%. Furthermore, Sijal is carrying a really heavy debt load. They have 202 crore in borrowings, whereas ATGIL is practically debt-free.
And this is where the market psychology becomes so fascinating. Despite Sijal having half the profit margin and carrying massive debt, the public markets actually value Sijal at a much higher premium.
How much higher?
Sijal trades at a price-to-earnings, or PE ratio, of 29.6x. ATGIL, even if we calculate it on a fully diluted basis after this new stock issue, trades at a PE of just 14.1x.
So the stock market is willing to pay twice as much for 1 rupee of Sijal's earnings than they are for 1 rupee of ATGIL's earnings.
Exactly.
That feels wild when ATGIL is the one with the 33% margins and basically no debt.
It really forces you to ask the ultimate investor question, what
Right.
kind of risk are you willing to take?
Right.
Do you value a smaller, highly profitable company that is currently choking on its own growth and struggling with cash collection? Or do you prefer a massive lower margin company burdened with debt, but that has proven it can actually generate positive cash flow month after month?
It's the promise of growth and high margins against the safety of scale and actual cash generation. The market is clearly applying a huge risk discount to ATGIL.
They definitely are.
They are looking at that 14.1x multiple and saying, we love your 33% margins, but we just don't believe you can maintain them while fixing your negative cash flow and expanding nationally.
The market prizes certainty, and a positive cash generation provides certainty.
This has been a phenomenal breakdown. We started this deep dive simply by looking up at the glass on a skyscraper, and we've managed to unpack the entire financial and operational engine required to put it there.
It's a lot of moving parts.
To summarize everything we've pulled from this dossier today, ATGIL is successfully capturing the high-value architectural glass market. They're moving aggressively past basic toughened glass and dominating in premium insulated, laminated, and heat-soaked products.
Right.
They boast incredible 30+% margins and very low debt. But they are currently wrestling with the immense cash-draining realities of rapid expansion. This is forcing them to dilute their founders' equity just to fund their working capital pipeline and build the capacity for their national ambitions.
It is a high-wire balancing act, for sure. And if I can leave you with one final thought to mull over as you think about this industry.
Please do.
Look at global regulations right now. Cities worldwide are rapidly pushing toward mandatory net zero emissions and incredibly strict green building codes.
Right, it's a huge trend.
Because of this, specialized glass processors are going to undergo a fundamental identity shift. They are transitioning from being viewed as optional luxury architectural suppliers to being absolutely essential climate tech infrastructure.
Wow. In a few years, you literally won't be legally allowed to build a compliant commercial building without their high-end insulated glass.
Exactly. The demand is mathematically guaranteed to accelerate. But the ultimate winner in that future landscape, it won't necessarily be the company with the cleverest glass engineering or the largest heat-soaking ovens. The company that survives to dominate the market will be the one that can scale its operations while mastering the incredibly unglamorous art of getting its invoices paid on time.
You can't save the planet if you run out of cash on a Tuesday. The winner is the one who solves the working capital trap. What an incredible look under the hood. Thank you so much for joining us as we unpack the hidden mechanics of ATGIL. The next time you walk past a modern high-rise or look out a towering, energy-efficient hotel window, just take a second to appreciate the fragile, chaotic, beautifully engineered business it took to put that glass exactly where it is.